Hey guys, welcome back. In today's video, we are talking about how AMC will be making millionaires, the short's real problems, markets ready to blow, and many more in this video. First, we're taking a look at this. Huge deep dive into margin calls of Apex and Robinhood during the Jan 28th, 2021 squeeze of GameStop and AMC stock. They're in control 99% of the time. The other 1% of the time, though, is enough to make many millionaires and billionaires. Now, as always, feel free to check it out, obviously, for a different perspective. But I want to talk about this and use what we've talked about on this channel in the past before. And the main focus is about understanding the control 99% of the time and the 1% slip up. So many of you guys know that AMC is one of the most, if not the most manipulated stock that it's out there. And what we've seen in the past is obviously the different methods they used. You know, it ranges from swaps, options, all the way into crypto, and of course offshore, and many other strategies that they've done in the past. And this is obviously what we mean by they're in control 99% of the time. Now, the reason why they do this, and again, for those who are familiar with this particular pie chart, what you are seeing right now is about understanding in terms of the risk that carried with AMC and GME for brokers, for hedge funds, and for clearings. And what we know was the VAR for Robinhood, and again, this is only talking about Robinhood for this instance, is obviously how AMC held the most risk, and then it was GME, and then it was all the rest. But AMC was the riskiest stock for Robinhood at that time. And this is what we talked about, understanding that they, in 99% of the time, are controlling the stock because they understand how much is at risk. But the 1% of the time when they do slip up, that's enough to make millionaires. And this is a very simple understanding. It's obviously just understanding, even with when it was just one broker, AMC was already the most risky stock. Now, bear in mind that there's obviously different brokerages that are out there. Robinhood is not really the brokers for hedge funds. They only are, you know, payment for order flow really for the hedge funds. There are, of course, other brokers that we've seen also cancel buy orders on AMC that also struggle to locate shares of AMC. And those are the main ones that we should be looking at. But it's even understanding the fact that Robinhood was struggling for AMC, was struggling to locate, was struggling to find the margin for AMC. It lets us understand, you know, what everyone else was, of course, doing. And so we know that since 2021, of course, there have been billions new synthetics that have been created throughout the time. And that's why the situation is even bigger now. We could be easily looking at the value at risk for Robinhood to be 10 times, 20 times, or even 50 times bigger than it was back then. And again, what I want to clarify is that this is only for one firm, let alone all these other firms that are, of course, out there, whether you're looking at the brokers, the clearings, the banks, the institutions. There are so many parties that are involved, and that's why this situation is getting even bigger. If this was only a $100 billion issue back in the days, right now we could see it going into the trillions. And that's why the shorts try to manipulate AMC, you know, 99% of the time. And bear in mind, they do want to control it 100% of the time, but they struggle, and that's when that 1% comes from. Now, you can see how one of the things, and this is why we're seeing why that 1% is actually getting bigger. Making more naked short shares to sell them, buying short shares to cover on a manipulated dip, shorting hedge funds have a real problem. And I think that this is a very, very good picture, and it actually shows what's happening for AMC. When AMC dips under $4, you can see everyone's lining up to buy the dip, and no one is here to paper hand the dip. Now, obviously, in reality, there will be people selling. But what we can see, and it's what we talked about in terms of how the shorts have made a major mistake, is that they believe when they suppress the price of AMC below $4, everyone is going to leave. So they think that the line is obviously going to be on this side. But the matter of the fact is, where everyone, or at least 99% of the retail investors, see that AMC is below $4, they actually buy even more. So the effect that the hedge funds want to create by pushing the price down and forcing people to get out is actually doing the opposite. They're pushing the price down, and they're actually encouraging now people to get in, and that's the incentive they have created. And that's the problem they have created, because remember, when they create these dips, they create these dips using synthetic shares. The synthetic shares that then bought up will have to be covered in the future. And so that's the cycle they've put themselves in, and that's why they're always worrying about this problem. And not just the retail investors. What we've also seen is obviously institutional ownership going up as well. And so you can see actually just the buy orders, the buy volume of AMC has only been increasing. So even though we're seeing the price go down, now we already know that when the buy volume goes up, the price is supposed to go down. But obviously it doesn't work here in AMC. What you actually see is the buy volume going up and the price is still going down. That's obviously because of the suppression. But like we talked about, as we see the buy volume going up, it means that they've created more and more synthetics. Essentially what they're doing is that they're trying to not only fill the demand, but also bombard it with even more supply in the eventual hopes that people don't then have any more demands. But of course, that's not going to be the case because everyone is willing to buy the dip, and that's what they are afraid of. And you can even see here from a different short seller, more than 38,000 trades in the principal amount of more than 2 billion over a year. What stocks and how many shares were traded, how much money did UBS make, how much did its investors lose, and this is what we're seeing. So UBS was fined 3.5 million for alleged lacks of supervision of short-term trading. Now, it's shocking and not shocking at the same time that UBS is involved. And what we've seen is obviously UBS with their positions in the toxic swaps of GME and AMC, which they obviously inherited from Credit Suisse, who inherited it from kohrs. And now what we're seeing is, again, the lack of fines, a 3.5 million. Now remember, is that they were overtraded in terms of principal amount of more than $2 billion. Easily, they could have made hundreds of millions of dollars, yet they were only fined, a 3.5 million to settle allegations. And now this is, of course, nothing new. We've seen how firms who have made billions of dollars have only been fined, less than 1% of the money they've made. But it's the fact that they are doing this. And again, we're not surprised that they're doing this because of the situation that they're in. 38,000 trades. Now, when you see one of the stocks that's going to have a major impact on them, AMC, GME, and you're seeing that they are, of course, doing these things for short-term trade, which obviously is very likely to be used for the manipulation of price, you understand what is happening. And so it's what we talked about in terms of understanding how when you do see that they have a conflict of interest and that they are scared of stocks that will put them heavily in debt, you see all these corrupted methods that are coming out, and UBS is obviously one of them. Another thing is understanding, in my opinion, all fund managers are seeing the same thing. A market top ready to blow. Instead of holding cash, which generates $0 returns, they're all shorting major indices. They've hedged their portfolios to profit from the incoming correction. Now, this is very important, and it's about understanding the overall market. Recently, we talked about the reverse repo is under 100 billion for the longest time ever. We've seen it go all the way up to 2 trillion, and now it's below 100 billion. And that's obviously a very big tell of the lack of liquidity, the lack of capital. And so what we're going to be seeing going into the future is how shorts are going to be struggling with cash, which means that they will struggle with financing their short positions and create new short positions like they have been doing. But what we're also seeing is the fact, whilst they are shorting, the major indices to obviously hedge their positions, remember, one of the biggest reasons why they could get their hands on cash in the first place is because they've longed on the overall market and they took collateral out on those. So whilst, yes, when we do see the market at top and it blows and they can make money from these short positions, remember their collaterals are also falling in value. And it's very likely that these hedge for their positions is only going to minimize their loss rather than actually making a net profit. And that's going to eat into their capital. And so going into the future, we have multiple factors, wherever it's ranging from the reverse repo, wherever it's going in terms of kind of the tightening of regulations, wherever we're seeing the overall market drop, we're all going to be seeing the lack of money, the lack of liquidity available for these firms. Remember, just a few weeks ago, we saw how Citadel was willing to sell a minor stake in their company. Now, why would a firm that is constantly be making money, that is the most profitable hedge fund in the world according to them, and again, a healthy cash pile, able to get give back to the investors, why would they want to sell a minor stake of their company for cash? And when you consider the fact that they've been taking up loans, they've been creating new loans, and that they are willing to take loans on a bad rating, it's all, of course, leading to one thing: they lack money, they need money, and they are not in a healthy position. And so that's what we talked about. Going into the future, there are multiple signs that shorts are, of course, struggling. Now, we're also seeing this GME getting tagged for over 110 million worth of dark pool orders since market close. Now, what we can be seeing is, of course, the volume going up, and that itself is very important. As we see the shorts lacking liquidity, any volume that could come in could be the last hay to the the overall stack, and that would be what we want to see. But yeah, guys, thanks for watching this video. I'll catch you guys next time.